Hello, everybody. Welcome. We're just going to get it a minute or so for people to come into the room and then we'll get started. You're in the right place. Welcome, everybody. We'll get started in just a minute. Welcome. Just waiting for some more people to enter the room and then we'll get started. Okay. Hello, everyone, and welcome to our next webinar in the Back to Basics series, Accounts Payable, Accrued Liabilities, and Long-Term Debt Reconciliations. We're happy to have you here with us today. Before I introduce our presenter, I have a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and other resources. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speaker, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards. LSL is using a new CPE system, so please note that the evaluation email will be coming from LC Vista. Please allow up to 1 week to receive this email. If you're having trouble seeing the polls, try minimizing the Zoom screen as it sometimes the poll question box pops up behind it. You may need to click and drag the Zoom screen around a bit to see. If you're using multiple screens, check each one as it may pop up on another screen. If that doesn't work, you may need to disable your pop-up blocker. Now I'd like to introduce our presenter. Jayme Lambert is a senior manager in LSL's Assurance and Advisory Department with extensive experience leading audit engagements for local government agencies, including cities, counties, and utility districts. He oversees all stages of the audit cycle, from planning and risk assessment to fieldwork and final reporting, ensuring every project meets high standards for compliance and accuracy. With over a decade of experience, Jayme understands the hurdles finance teams face and works side by side with clients to simplify reconciliations, strengthen internal processes, and promote collaboration across departments. Whether he's leading an engagement or advising on complex reporting issues, Jayme is committed to advancing the financial health and accountability of the public agencies he serves. Okay, Jayme, take it away.
All right. Thank you, Rachel. I appreciate that introduction. And like was previously mentioned, the topics we're going to cover today are going to be long-term debt, accounts payable, and then payroll and other liabilities. And alongside the payroll liabilities, we'll spend a little bit of time talking about the changes coming to compensated absences related to GASB 101. With that, we'll get into our first polling question. Are you ready for the fiscal year 2025 audit season? Yes, of course, definitely, and absolutely. All right. Glad to see everyone's ready. All right. So while y'all are answering that, I'm going to get on to the long-term debt section. Per GASB 88, the definition of debt for purposes of disclosures is a liability that arises from a contractual obligation to pay cash or other assets that might be used in lieu of cash in one or more payments to settle an amount that is fixed at the date the contractual obligation is established. Essentially, per GASB 88, any agreement to pay on a future date is considered a debt. One other thing I should mention actually is, a lot of these debts, and when we're talking about long-term debt, we're talking about items that are, recorded at the fund level for like proprietary funds, and then are reported for governmental funds on, on the government-wide statement. Types of long-term debt. It's a general obligation debt, which is secured by the full faith and credit of the government issuing the debt. Revenue debt, that might be secured by specific revenues, such as like water revenue, lease revenue, things of that nature. And then special debt assessment debt, which might be secured by assessments, such as debt issued for road improvements that benefit a certain area, and then are secured by taxes levied in that area, something like that. Additionally, there's lines of credit, promissory notes, loans, financing agreements, leases, subscriptions. There's all sorts of different types of debt. This is not an exhaustive list, but just a good example of what types of debt might be out there. Debt proceeds should be recorded in the funds designated by the debt agreement when the debt is issued. Additionally, deferred amounts on refunding should be recorded in the same manner as the proceeds and then amortized over the life of either the new debt or the refunded debt, whichever is shorter. And deferred amounts on refunding occur when new bonds are issued to pay off essentially an older debt. That was established by GASB 65, and you can have a deferred gain or a deferred loss depending on the debt that you're refunding. As payments become due, debt expenses should be recording using the same fund designated by the debt agreement. If, for example, a city decides to begin paying for debt that was initially designated to be paid for by that city's, like an enterprise activity like the water fund or something like that, those obligations should still be paid for by the fund designated in the agreement, and then a transfer should occur from the fund designated by the governing body into the fund that was designated by the debt agreement. Additionally, prepaid insurance costs related to debt are included in amortization of the debt, but other issuance costs are not amortized. Briefly talk about debt premiums and discounts. A premium occurs when debt is issued that includes proceeds received at greater than the face value of the underlying bonds. And a discount occurs when debt is issued that includes proceeds received at lesser than the face value of the underlying bonds. Essentially, a premium occurs when when you sell bonds for more than they're worth, and a discount occurs when you sell bonds for essentially less than the debt is worth. Premiums and discounts should be recorded in the same manner as the related debt instrument and amortized over the life of that bond. Premiums and discounts affect interest expense when they're amortized. So when you record your entry every year and you hit your premium and your discount, that's going to either decrease your interest expense if it's a premium, or it's going to increase your interest expense if it's a discount. Interest payable is recorded based on the amount attributable to the fiscal year being closed. So in this example I have here, it's a 6/30 year end and the debt payment's due on September 1st. So we would need to accrue the portion related to the months from March through June, which would be 4 of the 6 months covered by this interest payment. And that accrual would be about $270,000. You should know what your debt agreements say, and part of that is knowing what your debt covenants are. If you're, for examples of debt covenant requirements might be a cash reserve that's required to equal to a specific dollar amount. Instead of that, it might be an insurance policy that's required it's in lieu of the cash reserve, and that's the insurance policy is to guarantee payment. There might be specific revenue thresholds or targets that are supposed to be hit that are related, to the debt instrument or the type of debt it is. Essentially, debt covenants can exist for many different types of items, and you should just be aware and reading the debt agreements to ensure your entity is in compliance. If your entity's debt covenants can allow bondholders to demand payments within 12 months, that could mean, if you're out of compliance, that the entire debt may have to be classified as current instead of non-current. So it's important to be keeping up with these. I don't think debt compliance is something you should only be concerned with at the end of the year. You should be regularly keeping up with those, making it part of your month end or your quarter end checklist. and figured out what you need to do and make sure that you're in compliance so that you're not running into any issues during your audit. What information is needed for the audit of long-term debt? One thing we're going to ask for is a debt roll forward, and I'm going to give an example here in a second. We're going to want evidence of compliance with your debt covenants. We're going to want documentation of any new debt added during the year, any amortization schedules related to any new debt, including schedules of premiums, discounts, or any deferred amounts on refunding. We're going to want your calculations that you prepared and any entries recorded for the new debt, and including any initial debt proceeds entries or any calculations of the deferred amounts on refunding. And here's just a general example of a roll forward. This is kind of what, as on our end, what we prepare while we're doing our audits. And what you'll see here is, you have this column here, that's the beginning. It should agree to your prior year ACFR ending balances of your debt. Additions here would be any new debt or any changes in debt that might increase the debt during the year. Additionally, you'll have any deletions, which will be payments made throughout the year, and then the ending balance, which again should accrue to either what or agree to what you have recorded at the fund level, or if it's governmental funds, should agree to the government-wide. Additionally, you'll want the principal due within 1 year, which will be the current portion that'll be recorded on the financial statements, and this amount for the accrued interest that ties back to the accrued interest that you put on your fund at your fund level as well. I also included this footnote example from GASB 88. I don't want to like go through this whole thing, but I put it in here because these slides will be made available to you, and you said this will be a part of the slides for you. One thing I do want to note, though, and that I didn't mention is right here. You'll see that in the narrative of this disclosure, they included an unused line of credit in the amount of 1.5 million. You'll note that this is not on the roll forward in the footnote, but it is in the narrative. So you want to make sure any kind of, lines of credit, any other kinds of debt you have out there that you might not, maybe your entity's not really using, that you are still disclosing that in your footnotes. All right, that brings us to polling question number 2. What's one thing you wish you had more of? Money, fame, free time, or GASB pronouncements? And I know putting the GASB pronouncements in there, that just means it's a shoe in. But, I thought I might give these other options just in case you prefer one of these other things. While you guys are answering that, we're just going to keep moving. Next, we're going to talk about accounts payable, payroll liabilities, and other liabilities. And in this instance, we're talking about liabilities that are more short-term in nature. So as opposed to long-term liabilities, we just discussed like long-term debt, which are typically recorded at the fund level, proprietary funds, and at the government-wide level for governmental funds. These are short-term liabilities and therefore are more likely to be recorded at the fund level for all types of funds. First, we'll talk about accounts payable. Accounts payable should capture expenditures that apply to the fiscal year that will be paid after the fiscal year end date. So, for example, you have some work being performed on a new building that the city's building, and a contractor bills you in July for that work that was performed in June. That would still be considered accounts payable and should be accrued. For that specific example, it could also give rise to and have an impact on your constructions in progress amounts for your capital assets. So make sure you're taking that into account as well. You want to review any payments made after the fiscal year end to determine if services are rendered within the fiscal year. And that review of payments should continue through the end of your audit. You should prepare a reconciliation that agrees each fund's accounts payable general ledger accounts to your AP subledger. So you want your AP aging to agree to your trial balance for every fund. If your AP aging spits out a different number than you're showing on your trial balance, then you're going to have an issue that you need to investigate. For that reason, I think it's a good idea to reconcile your AP regularly, not just at the end of the year. You don't want to come, you're preparing for your audit and you discover that entries are being recorded to AP that shouldn't have been. And while you need to be getting prepared for your audit, you're trying to have to you're having instead to have to chase down a bunch of entries that shouldn't have been there. In some cases, I think, an entity might switch to a new accounting software, and they didn't know that every time they cut a check in that new accounting software, it records an entry to AP that then isn't getting cleared. Um, and then they have, kind of an issue on their hands. In addition, if you're providing reports to your council or your governing body regularly, if you're not recording your AP and putting your expenses to the appropriate period, then you're not really giving them a full um, picture of the expenditures to date, or what's out there at that time. You're just really giving it to them on a cash basis. Oh man, we actually had people pick GASB pronouncements. I am in awe of you individuals. Man, I like the free time one, so that would have been my choice, but there you go. Let's see. On to our next slide. Did I skip it? No, I did not. Okay. All right, next we're going to talk about payroll liabilities. Payroll liabilities are accrued amounts related to employee compensation and other payroll-related expenses. For this slide right here, we're really talking about salaries and wages. You should prepare an accrued payroll calculation using the first payroll distribution report following the fiscal year end, as well as any subsequent payroll distributions that include dates from the fiscal year end. On the next slide, we're going to have an example that deals with a 9/30 year end entity, and their first pay date of the new fiscal year was October 12th for a pay period of September 26th through October 9th. So really, all of their accrued payroll was covered on one pay period. Um, but you could have a situation where they also paid on October 1st, and then that entire pay period was actually for the fiscal year ended, and that would also need to be accrued. So just be sure you're keeping track of that and making sure you've captured everything. So here's the accrued salaries calculation example. And like I said, this is for an entity with a 9/30 year end with a pay date of October 12th. And as you can see, the pay period was from September 26th through October 9th. And that would be 5 of 14 days, which is 35.7%. But, for here it says 36%. And we split that out by fund and recorded the accrual to each fund based on where those employees are, based on the fund that those employees would typically be paid out of. To ensure accuracy of a benefits payable, it is recommended to complete reconciliations regularly, at least monthly, but preferably for each pay period. You want to make sure that the amounts that are due and payable for each pay period are, being paid not only or being deducted from the employee's paycheck, but are also being paid out by your government, um, and that they're hitting the correct GL accounts. You also want to make sure that payments aren't being missed or you're not duplicating any payments. And you want to make sure that the payroll deductions are in line with payments that are made to the benefit providers. You want to make sure that everybody that's supposed to be, all the employees that are supposed to be having benefits deducted from their checks are actually having those benefits deducted. And you're not, your entity's not paying out more than they really should. Um, Another part similar to this is, making sure that the payroll taxes are being paid timely, and you're, preventing yourself from getting any kind of nasty letters from the IRS about payroll taxes. At the end of the fiscal year, determine if there are any payroll benefit accruals needed for the year ending, or if any amounts were prepaid to benefit providers for the upcoming year, and just make sure you're accruing for those. Additionally, we have things that we're calling other liabilities, which is essentially anything that's not, any other kind of short-term liability here. And one type would be due to other governments, which is really an account payable to another governmental entity. One example would be your entity collects sales taxes, but by law, maybe half of those taxes are belong to another entity. So, until you pay those funds out to that entity, that's due to another government. Another example would be retentions payable. Retentions are when you have a construction contract, and per the contract, or it doesn't have to be a construction contract. But just one example, per the contract, until you confirm performance of all of the details of the contract, you'll hold back a certain percentage from each billing. And once you've gone out and investigated and determined that, the work was performed to the specifications of the contract, you will then pay out that retentions amount to that vendor. Another example would be deposits payable. One type is customer deposits, which are for enterprise type activities, such as, when you cut somebody's water on, you're going to take a deposit for the end of that, that you will hold until that customer ceases that service. Or you might have developer deposits, which are potentially related to some kind of guaranteed work, like you've as a contingency of, or is it rezoning for a new type of business? Part of the contingency is that developer has to put in a new red light or put in a new lane. And to guarantee that performance, you've taken a deposit from that developer, that, at the end of that work, you'll either return to that developer or use, to guarantee that, what you wanted them to do is done. If, like, maybe even the city has to use that deposit or the entity might have to use the deposit to complete that work. So what information is needed for an audit of accounts payable? So the work papers that we're going to need are going to be the accounts payable aging, which should agree, as we said, to the amount recorded at the fiscal year end date at the fund level. We're going to want the cash disbursements from fiscal year end date through the audit field work. That includes all forms of payment, such as checks, wires, ACH or direct transfer payments, P cards, any type of payment. And we're going to want to look at your open encumbrance and PO rollover report as of the fiscal year end. And what are we going to do? Well, first we're going to take a look at your accounts payable aging report. And we're going to, first thing we're going to see is, you have really stale AP, things that are like 90, 180, over a year old. And we're going to test those for reasonableness. My initial thought is, if it's that old, it's probably not reasonable and it shouldn't exist. If you have a large credit balance sitting out from a vendor for a long time, I might even, essentially that's a receivable, not a payable, but I might even, seek a confirmation from that vendor that they agree that they owe you that money, essentially, just like we would do with any other sort of AR confirmation. Additionally, we're going to perform a search for unrecorded liabilities. We're going to select a sample from your distributions register of subsequent payments that were made, and we're going to test those to, verify that they were either properly included in your accounts payable aging, or they were properly excluded, or maybe they were improperly excluded or included, and determine, if there might need to be an entry made there. Additionally, we're going to look at your open encumbrance and PO report, and similar to the stale AP situation, we're going to see if, we think maybe you have some stale encumbrances out there that potentially need to be closed, and just, might provide some recommendations there. What information is needed for an audit of payroll liabilities? Well, the first thing we're going to ask for is the pay registers for the pay periods in the fiscal year under audit that were paid out after the year end date for that year under audit. So for our example that we showed, the pay period ended October 9th, but September 26th through the 30th were also included in that pay period. So we would want to see that pay register, and we're going to compare that register to what you have accrued. And we're also going to look at AP payments made for other payroll related liabilities, like vendor payments made for retirement, insurance plans, OPEB, your taxes, things like that. And, depending on your auditor, the AP payments might be done in conjunction with, the search for unrecorded liabilities or the other AP testing, or it might be done in a separate type of testing. So how does this info get audited? First we're going to recalculate the payroll accrual based on the final payroll registers, like I just mentioned. And we're also going to calculate some specific payroll related ratios, such as payroll taxes to total payroll, and compare those to prior year ratios to determine reasonableness. And for example, and large ratio fluctuations from one year to the next may warrant further investigation. And for example, in our payroll ratio type example, I mean, really, payroll taxes stay kind of static as a percentage of total um, payroll wages that are paid out. Your payroll taxes should, stay pretty level as a percentage every year from year to year. And if they aren't, then we're going to want to investigate that. And we're hopefully why that fluctuation exists, and we can figure that out and figure out why that happened and if that's reasonable. And then for an audit of other liabilities, we're essentially just going to look for schedules from you, schedule of your amounts due to other governments, of your deposits payable, and your retentions payable, and then we're going to select a sample from those schedules. First off, we're going to determine that the schedule agrees to your GL detail, obviously, but then we're going to select a sample out of those schedules. We're going to look at any relevant agreements. We're going to look at the legal statutes. We're going to look at maybe the water deposit statement, and determine that individual's account's still valid, that the deposit still exists and should. We look at relevant, invoices related to retentions payable, and agree that the amount shown on your payable is the amount that should have been recorded based on, the invoices that you've received, things like that. All right. So with that, we get to polling question number 3. Are you multitasking right now? Yes, I'm just here for the CPE. That's me. And then no, I'm totally focused on long-term liabilities. It's okay. You can lie to me. All right. So moving on to compensated absences. This is a payroll related liability, but it's different from the payroll liabilities we previously discussed, because compensated absences are more similar to long-term debt than they are to the short-term payroll and benefit accruals we just kind of went over. Additionally, with the changes coming in GASB 101 for fiscal year 25, I felt this topic needed a little more attention than the other payroll liabilities. One note to the side, LSL hosted a dedicated GASB 101 webinar earlier this year. It was a pretty good webinar. If you attended that webinar, a lot of this information is probably going to be reviewed to you. But with the changes, this is probably the biggest thing coming to, long-term liabilities and AP and payroll liabilities this year. So I just felt it needed a little more time and more discussion in this topic and with this presentation. All right, so we're going to talk a little bit first about the old standard, which is the standard we're all used to, with compensated absence accruals. Yeah, you're going to accrue time under GASB 16, which was issued all the way back in the 1900s, 1992 to be exact, way back in the dark ages, and was effective for fiscal year 1993. You would accrue time paid at termination or retirement, essentially only. The threshold to recognize was probable to compensate at termination. And this would be for all kinds of, leave, vacation, sick, sabbatical. If you paid it out at termination, you accrued it. The major change this year with GASB 101 is that it's going to require us to factor in future use of time already earned, even if that time wouldn't be typically paid out at termination. So we'll get into that a little bit. It's increased our threshold or decreased our threshold from probable to more likely than not. So here's the new standard issued for starting with fiscal years 2025. I appreciate all of you who lied to me and said you were just here and totally focused on long-term liabilities. Thank you, friends. So under the new standard, all amounts that were accrued under GASB 16 are still going to be accrued. You're still going to accrue everything that's paid out at termination, or when that person might leave employment. All those items are still going to be accrued. Additionally, we must now make an assessment to support a percentage of employees in a non-vesting population. That should include reviewing your policies, your historical info about leave usage patterns, and information about current and expected future eligibility. And they've, like I said, they've decreased the threshold from probable to more likely than not. GASB 101, as I said, is now in effect for everyone, and it gets retrospective treatment. So you're going to need to go back and restate your liability at fiscal year 24 year end. There's going to be a net position impact, and per GASB 100, there's going to be a disclosure about that. And then you're also going to need to then do your balances at fiscal year 25 year end. Recognition criteria now is for services that are already rendered, which means it accumulates based on work already performed. It accumulates across fiscal years, meaning it does not drop off at the end of the year. So if you have a type of leave that's only valid from year to year, like I don't know, if you have a floating holiday and if you don't use it, you lose it. That's not going to be part of it. And then it's more likely than not to be used for time off or paid out, as defined as greater than 50% likelihood. And it must meet all three of these criteria to be recognized as a compensated absence. The rate the rate of pay in effect as a balance sheet date should be used to calculate the liability. You're also going to include salary-related payments as part of the liability, which is new for GASB 101, such as employer shares of payroll taxes and also any required employer contributions to defined contribution plans, such as a 401k, a 457b, things like that. Not your pensions, not your OPEB. We already got a net pension liability. You already got a net OPEB liability. You don't need to accrue a second time for those. But any kind of salary related payment that is the responsibility of the employer, not the employee, needs to be accrued alongside the compensated absences now. So this is a change across the board. Even if you were following GASB 16 before, this is not something you were likely doing. Maybe you were, but that wasn't required. This is now required. You have to accrue for the payroll taxes. You have to accrue for any other employer side payments that are related to the payroll. Other changes, and I love these. GASB 101 allows disclosure of net change only, so you no longer have to say give the additions and subtractions to compensated absences in your footnote disclosure. You can just do a net change. And GASB 101 no longer requires the disclosure of the funds used to liquidate the compensated absence balances. This is probably the only good thing that GASB 101 did. All right, so the rate of pay in effect of the fiscal year, we're going to go into that a little bit more. Because we said that should be used to calculate the liability. And just to be clear, there is no requirement to estimate future pay rates for the accrual. And GASB actually addressed this in their most recent implementation guide, and I've got that on the next slide, so we'll go into that a little bit more. There are two exceptions. One is that leave is more likely than not to be paid out at a different rate. So for example, by your employment agreement, leave is paid out at half rate. On termination, you would accrue at that rate, not at the full rate. Also, another exception would be leave that is not clearly attributable to a specific employee. So for example, this would be, or the most common example I'm aware of is entities might allow for a sick leave bank. And in that instance, it should be accrued using an estimated pay rate representative of all of the employees eligible to participate. That might not mean they are currently participating, but if they are eligible to participate in the sick leave pool, what you need to do is take a, look at the population of people who can participate in that leave bank, come up with an average pay rate for that sick leave bank employee, and then create a compensated absence liability based on what that fictional sick leave bank employee would be. I hope that makes sense. I feel like I stumbled over my words there a little bit, so if you have any questions, I'll be happy to go into that further. And as I previously mentioned, GASB addressed the rate of pay in effect at the end of the fiscal year. There was a question posed to them that they addressed in the most recent implementation guide. And this person says a future pay rate that is known, a rate different from the employee's pay rate at the time the payment is made, as described in paragraph 17 of Statement 101. And what they mean by a future pay rate that is known, they're saying like they already know of next year's salary increases. They already know they just had a new collective bargaining agreement put in place. Should they accrue based on that pay rate change that they know? And GASB very clearly said, no, you don't do that. You accrue based on that individual's pay rate at the fiscal year end as it currently is at that moment. Um, and I think they go into different things here in their answer. I think really it boils down to you don't know if that person is going to quit tomorrow. So if accrue for a rate that might go into effect 20 days from now, I mean, there's no way to guarantee that person's going to be there tomorrow. So, you're going to accrue based on what you know, not, of that person's pay rate at the fiscal year end date, not sometime in the future whenever this agreement might go into place. Additionally, with recognition and measurement, compensated absences that are dependent on the occurrence of a sporadic event that affects a relatively small proportion of employees in a particular reporting period should not be recognized as a liability until leave commences. And these are the examples that GASB gave in GASB 101. It's things like parental leave, military leave, jury duty, holiday leave, and unlimited leave. And I'll speak briefly to unlimited leave because I was not very familiar with this. Unlimited leave does not mean, your entity allows you to accrue as much sick leave as you possibly can. That's not what it is. Just because you don't have a cap, that's not what unlimited leave is. Unlimited leave is where you don't really keep up with a bank at all. There's no vacation bank for each individual. There's no sick leave bank for each individual, or you don't accrue. Each individual doesn't accrue their own balance of vacation or sick or things like that. Instead, nobody keeps up with, a set, I have 300 vacation days or whatever. Nobody has that. Everybody just can use leave whenever they can and where they can get it approved and whenever it's, open to them. I know that's not very common, but I just wanted to clarify. So, because I did have a question in a previous time that I presented this about if that meant, leave where there's no cap, and that's not the case. But essentially for the rest of these are leaves that, this is leave that occurs based on an event happening, and it really doesn't follow the employee from year to year. All right, brings us to polling question number 4. Have you already updated your compensated absences estimates for the GASB 101 changes? Yes, no, or don't the auditors do that? I can tell you now the answer is no. The auditors do not come up with your estimates for you. But I guess that's a valid answer anyway. All right, while everybody's answering that question, we're going to move on to our examples. And these are similar examples when I gave this talk last year, so these might look familiar if you were in this talk last year. So the facts of assumptions of example 1. Vacation leave is paid out at 100% at termination at this entity. Sick leave is not paid out at termination. Your unused vacation leave at fiscal year end was 600,000. The unused sick leave at fiscal year end was 1.8 million. And then based on historical trends, 50% of sick leave is more likely than not to be used. And this is the part that's really going to be the heavy lifting moving forward with GASB 101. Figuring out, how to pull your underlying data, which I'm sure we all have available. And then identifying a good estimate based on those trends of the data that you're looking at. That's likely going to be unique to each government, which makes it a little more difficult to talk about specific scenarios, but that's why, I'm giving some very simple examples here. I realize you probably have much more complex scenarios than we're going to go over. But if you run into something and you have a question, I mean, I would encourage you to reach out to your auditors. Show us your methodology that you're coming up with. We'll be happy to tell you if we think it's reasonable. Like I said, we can't do it for you, but we could tell you if we think, you're heading in the right direction. We think that's, what you've got here is going to be reasonable. Before you start making all your calculations, if you show us, the information that you pulled and how you're going and how you think you're going to use it, we'll tell you if we think, what, we think that's a reasonable approach and that's something that we could be okay with. Okay, I thought I clicked next. All right, there we go. All right, under the old calculation, GASB 16 from way back in the 1990s, the vacation portion would be accrued at 600,000 because you're accruing 100% of it. It's going to be paid out at termination. The sick portion would not be accrued at all because you're not paying any of that out at vacation. These people aren't going to pay anything for sick leave when someone retires or resigns. So the total liability there will be 600,000. And that's only factoring in, the probable vesting amount. Under the new calculation, you still, accrue for the vacation portion, the full 600,000. But then in addition, like we said, we determined that 50% of sick leave is more likely than not to be used based on historical trend. So you're going to accrue that at 50%. And that brings our liability from what was 600,000 to 1.5 million. And that's before you add in the employer portions of payroll related items. So you'd also need to, so any kind of payroll taxes, um, anything of that nature that would need to be included. This factors in a total amount more likely than not to either be used or to be paid as a termination payment. In example 2, these are our facts and assumptions. You have sick leave paid out at 50% after 5 years of service. And then you have employees over 5 years service that have unused sick leave of 600,000. Then you have employees of less than 5 years of service, unused sick leave of 1.8 million. We have historically, estimated that 45% of employees currently under 5 years will stay past 5 years. And then we've also determined that 80% of sick leave is more likely than not to be used for time off or is for an employee that will stay on for more than 5 years based on historical trends. So what we're going to do here under our old calculation, we would still have to do an estimate of the 45% that we're going to stay past 5 years. So what we would have done there is the vested portion would be 50%, 300,000. That's the people already over 5 years who are going to get their 50% at termination. And then we'd have done the estimated portion of 1.8 million, and we would have taken those times 45% because we know they're going to go past 5 years, and we would have accrued 50% of that for 405,000 for a full total liability of 705,000 under the old calculation. And that's just factoring in probable. Under the new calculation, you still have the 300,000 for the people who have already over 5 years who are going to be paid out 50% at termination. But then, because we've determined we're no longer looking at this 45%, we're looking at this 45% plus we're adding in 35% to that to make a total of 80% because 35% of sick leave is going to be used over the life of the employees. So then you would take your estimated portion times 1.8 million times 80% times 50%, and that increases the total to 720,000. Your liability becomes 1,020,000 plus your employer portions of benefit payments. This factors in a total amount more likely than not to be used or paid as a termination payment. So what information is needed for the audit? First, we're going to want your copies of your employment benefit policies. We're going to want to see your estimation and your calculation support. We want to know how you came up with your historical forfeiture rates. We're going to look at those and we're going to determine if we believe they're reasonable. And then we're going to want your change in pay rate adjustments as well. All right, so before we move on to questions, I wanted to quickly mention, that we're going to have a webinar coming up August 26th about leases and subscriptions, which are another type of, a debt item, but it also includes compensated absences piece. So we're going to have a full, webinar about that. Additionally, as I mentioned, there's already been a webinar completely dedicated to GASB 101, and there was also a webinar completely related to pensions and OPEB. And you can find both of those recordings and the related slides on our website. And please do sign up for this, upcoming webinar. I know I'll be there. I'm looking forward to hearing what Nicholas has to say about leases and subscriptions. All right. So with that said, I will get into the questions here. One question says, is the 50% sick leave assuming it will be used within the next fiscal year? For example, if audit year end is 6/30/2025, is the 50% what we think they will use for fiscal year 6/30/2026? The answer is no. What it should be accrued based on what would be used throughout the life of the employee. So you would, I think I'm understanding the question there. I hope I answered that, but no, it needs to be, the full balance needs to be accrued. And that's why it's considered a long-term liability, and also why it would be recorded at the fund level for proprietary funds and then at the gov-wide level for governmental funds. Let's see here. I don't see any other questions in the Q&A. Okay, here we
Hi,
go.
Jayme. We actually have a question that's in the chat. So it says, for sick hours to be converted to service credits, would that portion be excluded after the total liability calculation, or should it be incorporated before? Let me know if you need me to repeat that.
Hold on, let me look at that chat real quick. Let's see. For sick hours to be converted to service credits, would that portion be excluded? Okay, so no. So for purposes of GASB 101, if it can be converted, it also needs to be included as part of the calculation. So if it can be converted to a retirement, or if it can be converted to other types of leave, if they can sell it to be used as a direct payment, all of it is included. And I guess I should have included that in the slide. I apologize. But yes, anything that can be paid out in any way needs to be included as part of this calculation. I see a question here. How are Medicare taxes incorporated into the calculation? So essentially, any sort of tax that is paid by the employer on behalf of the employee is included as part of the calculation. Let's see. Then I have, for comp absences, the GASB 101 accrual is posted to year end and then reversed in period one of the new fiscal year, correct? Typically, I would say if you are keeping a long-term liability, I don't know why you would want to reverse it, but I guess that's certainly an avenue you could take. I don't think that's necessarily wrong, but that's something I think most people would just adjust it from year to year, to whatever the new calculation is. I have a question here. Do CalPERS employer contributions need to be factored into the GASB 101 calculations? And the answer is no. So you're already doing a net pension liability. You're already doing an net OPEB liability. You don't need to include those contributions in the calculation. I have another question here. How do you determine whether to use first in, first out, or last in, first out method when calculating the future leave usage? I think I might need some more information on you about what, I don't know that I have a specific recommendation. I might need to see that specifically about your entity to see. I mean, personally, you have your leave bank, your hours have accrued, you've got this time accrued. You wouldn't change the rate of pay based on when it was earned. you would just accrue based on the hours that have been earned and at the rate of pay at the end of the fiscal year. So I'm not sure I exactly understand what we're asking there. If you could just reach out, I'd be happy to look at that with you closer. I see another question or a comment. Our county allows for up to 1 year of sick leave to apply towards service credit and CalPERS pension. There is no payout of sick. If you could, I would like to look at that closer just to give a better answer. If you could reach out to me, I would love to talk to you about that and see what your specific policies say. All right. Let's see. Are there actuaries that can prepare these numbers for us? I will say I haven't talked to any actuaries that I know of that have said they are interested in preparing these numbers. I do know that we have a government consulting team here at LSL that has prepared these calculations in the past and would be willing to help you with your calculations. We're going to have contact information here. I'll go ahead and pull the next slide up. If you want to reach out, at this contact information, we'll be happy to discuss that with you. I have one question. For taxes paid by employer, you just take your total estimate and multiply it by that percentage. I think that would be a valid way to accrue for the payroll taxes. Yes, because the payroll taxes should be a specific percentage. And that percentage should, you should know what that percentage of payroll tax is. I think that would be a valid way to do it. Yes. For GASB 101, how do we report the current portion of the expenditure at the fund level for governmental funds? So I don't think there hasn't really been any change there from GASB 16 when you would record it just as you always have. You would have your current portion. I think there might be a little bit more of a calculation because you're doing so much more in long term, but I know some people just record half of it as short term, half of it as long term. Some entities like to apply, they might determine that only 20% is used from year to year and they'd accrue 20%. Essentially, the short-term portion is, an estimate, again, based off of, what is traditionally used from year to year. All right. And then I have another question about current and long-term, which I hope I just answered. And I think I have some other questions here and seem a little more related to specific entities. If you could reach out about that, that would be great. Okay, so someone asked to record the liability in the governmental funds. No, for governmental funds, you record it on the government-wide statement. For proprietary funds, you record it at the fund level. I guess maybe I misunderstood that previous question. And short term and the long term on the government-wide will be recorded at the government-wide level. And a question, how far back should we be looking for this historical sick leave averages? I would recommend, 2-3 years should be sufficient. But again, look at it and again, throw it back to your auditors, let them, tell you if they think, what you're looking at is reasonable. For your entity, maybe that, maybe there's something happened and, that maybe that's not really a reasonable basis, but I think, 2 or 3 years should be reasonable for most entities. All right. There are a couple other questions here. If you guys could reach out to me directly, I would love to answer those questions for you. We're running up on time, so I don't want to hold anybody any longer than I have to. I appreciate you all coming out.
All right, thank you, Jayme, for the great presentation. Just a reminder, you will receive the recording and the slides later today in an email. And if you have any additional questions, please do reach out. Thank you, everybody. Have a great day.